Breaking news out of the South Bay involving Silicon Valley Bank.
Federal regulators shockingly shuttered Silicon Valley Bank. The collapse of Silicon Valley Bank.
And so the world of banking came crashing down last week. For those of us who have survived and lived to tell the tale of the 2008 crisis, these unfortunate events that unfolded last week in the world of banking sent jitters down the spine. Truly, really, it obviously caused shockwaves across the world of finance. On Friday, the 10th of March 2023, US regulators shut down Silicon Valley Bank, the largest bank to fail since 2008. So who was Silicon Valley Bank? Headquartered in Santa Clara, California, SVB was the 16th largest bank until the fateful morning of the 10th of March 2023. Founded in 1983, it was at the center of the startup ecosystem in America for the past 40 years. It provided banking services to more than half of the country's venture capital-backed startup companies, mainly in technology and life science sectors. There were two main parties to the bank: venture capital firms and startup firms. Venture capital firms are a group of investors who provide capital to startups in exchange for ownership in the company. They pool money from individuals, families and friends, banks, corporations, retirement funds to be invested in startups. This is people's private money. The money at the VCF is legally required to be held at a bank which acts like a custodian who is supposed to then safeguard it and ironically prevent it from being stolen or lost. And SVB was such very popular custodian bank amongst the VC firms. So any new money flowing into VCFs, either through profits or new funds, all of which naturally went into their bank accounts at SVB. Party number two were startup firms. SVB was at the heart of startup ecosystem as they not only favored tier 1 startups with great growth potential, but also favored the neglected tier 2 and tier 3 firms. These are the newbies with barely any revenue. It's generally considered extremely hard for new firms to access mainstream banking services and open a corporate account. In that, SVB was a beacon of hope for such firms and was therefore very popular. So when these startup firms got funding from venture capital firms or some angel investor, the money got deposited into their account with SVB. Now, the low interest rates between 2019 and 2021 and the stimulus paycheck or free money by the US government during the pandemic created a gold rush for the startup industry, leading to VC fund explosion. So there was a sudden increase in the startups and they were getting a ton of cash from VC firms, which was subsequently deposited with SVB. So SVB's wide customer base obviously led to a large influx of deposits, leading to nearly $180 billion as of 31st of December 2022 from just $60 billion in 2018. All was hunky-dory up until now. SVB had a healthy balance sheet and its share price rose exponentially during this period. We all know the most common way banks make money is by investing the excess deposits from their customers in various investments. So like any regular bank would do, SVB utilized these deposits in excess of its capital reserve requirement to buy long-term debt like treasury bonds and other secured bonds to generate returns. Typically, these are considered risk-free investments with modest returns. Unlike what happened in 2008, the quality of these bonds wasn't the problem. The main issue, however, was the bank's short-sightedness in buying long-term bonds at the time when interest rates were at all-time lows. In one of my recent videos on interest rates, I talked about how bond prices move inversely to interest rates. So when interest rates rise, bond prices of existing bonds fall. But if held until maturity, there is no real loss to the bondholder. So then, what caused the problem for SVB? Simple answer is, it ran into a liquidity crisis. Basically, it ran out of cash. But this didn't happen overnight. Over the past year, the cash at SVB was drying up as its startup clientele was seen rapidly withdrawing their deposits to keep up with the increased cost of running their businesses due to economic downturn and rising interest rates. Many of these firms failed to generate any income and they were not able to get any additional rounds of funding. So naturally there was excess withdrawal from SVB, but nearly not enough new deposits. To keep up with the withdrawal demand, the bank had to sell some of its bonds prematurely at a massive discount. Because, like I just said, they had now fallen in value due to rising interest rates. This obviously led to a big dent in its balance sheet. But the final nail in the coffin was on the 8th of March 2023 when SVB publicly announced that it was seeking to raise capital of $1.25 billion to plug the hole caused by prematurely selling the bonds. Raising money to cover the losses can't obviously be good news for any company. This naturally triggered panic amongst its nervous clients, particularly the VC firms who had their money parked in the bank, causing an all-out bank run. Bank run is when depositors panic withdraw their money from a bank, which would be a problem for any bank. And that's what led to SVB's unfortunate freefall on the 10th of March. While it must have been a dreadful few days for those clients who had their money tied up with the bank with no access to it at all, in a recent development, the US Treasury and FDIC have jointly taken over the bank and have announced that the depositors will have access to all of their money sooner or later. And in a further positive development, the UK arm of SVB is now acquired by HSBC on Monday the 13th at a symbolic £1 at no cost to the taxpayer. While it's a momentary relief for all those who are directly associated with SVB, we are not out of woods yet, and the broader equity market continued to remain on the edge. When markets opened on Monday, another shoe had dropped as New York-based Signature Bank was shut down by financial regulators on Sunday, which is believed to have had ripple effects from the aftermath of SVB. Yet again, it is believed that the liquidity concerns due to torrent deposit outflows by nervous depositors is what caused the unfortunate shutdown. Stay tuned for more updates.